Investors looking to earn more money from their investments now are often turning to real estate. Today, we are excited to have Brad Thomas, the founder of Wide Moat Research, with us. Brad, you have been studying REITs for a very long time.
Yeah, I have. And of course, I've been studying real estate a lot longer, Bridget, and thanks for having me here as well. So I started in real estate right out of college, which is over 3 decades ago. And I spent about 2 decades of that really in the trenches, learning how to create value in real estate from literally from the ground up. I built buildings for a lot of companies. Maybe you recognize Walmart, McDonald's, Walgreens, and CVS, and Family Dollar, and Dollar Tree, PetSmart. So I was a landlord to those companies, and again, built their buildings and leased them back, and really understood the concept of rent collection and how compounding can help create value. As a private developer, some of the things I've really struggled with, again, with this transition from building private real estate to public, is a couple things. There's really four different really attributes that really make REITs attractive. The easiest one is transparency. One of the things that I struggled with in the private world with various partnerships is that I couldn't obtain financials to a lot of my investments, and that was really a problem because I wanted to get quarterly reports or annual reports and earnings call transcripts and things of that nature. And so I found out through the REIT structure, real estate investment trust structure. Obviously, these ordinary stocks that trade on exchanges, which require SEC compliance. So having that transparency is really an important attribute. The other one I mentioned is diversification. Again, going back to my real estate career in the private world, I built shopping centers and freestanding properties, but guess what? I never could have accessed a lot of these sectors today that are really attractive, such as technology, the data center sector, or the cell tower sector, or logistics, leasing to Amazon, for example. Or I never could have accessed, for example, casinos. I never could have become a shareholder in Caesar's Palace, or I never could have become a shareholder in the Empire State Building, which means I'm a fractional owner in these properties. I joke with my kids a lot that I own Caesar's Palace, I own Empire State Building. They laugh at me, and I'm like, no, I'm serious. I'm a shareholder. I'm an owner, a fractional owner in those iconic properties. So diversification is certainly another factor that's important. I think the other thing is dividends. I think this is probably the most important attribute for REITs because I wrote a couple books on REITs. My latest is called REITs for Dummies. If you like the Dummies books, and I certainly enjoyed writing the Dummies books. And one of the things I wrote about in the book is the requirement by law. The law was created in 1960 by Congress as part of the CIGAR Act. So that law with REITs is that these companies must pay out at least 90% of their taxable income. In fact, Bridget, most of them pay out 100% of their taxable income, which is what makes this asset class appealing for a lot of investors because you get higher dividend yields than you would, say, a traditional C corporation. So REITs have that attribute, and of course, we like to invest in companies and recommend companies that not only pay high dividends but pay sustainable and growing dividends. And so I think transparency, diversification, and dividends are really the three attributes that I would point to that make REITs attractive.
Let's dive into what's going on in the economy right now when it comes to real estate. We know that economic factors like the Great Recession that you mentioned, COVID back in 2020, can all really impact this market quite a bit. What are we seeing right now?
Well, you make a good point there. And look, I mean, we look at these different economic cycles, the recessions. Again, the great thing about REITs, going back, we have a law that goes back to 1960. So we can look historically at how REITs have performed through multiple business cycles or economic cycles. Now, of course, COVID is the first pandemic that I've lived through, and hopefully, frankly, the last. But also, we can look at that history to see how not only REITs but real estate in general performed or underperformed in some cases, during COVID. COVID was obviously an outlier, a black swan, an event that nobody predicted, and again, hopefully, we won't see that again. But what's interesting is to take, for example, the office sector. That was probably the most beaten down property sector, and it still continues to reinvent itself in some form or fashion. Now, in some ways, office has benefited certain markets. Down in South Florida, for example, I spent a lot of time in West Palm Beach and Miami and Fort Lauderdale, and you've seen an acceleration of demand as a lot of those companies that had office facilities in New York City or San Francisco have relocated to the South, mainly due to the temperature, the taxes, their friendlier tax states, and just cost in general. So we've seen an acceleration in demand after COVID in a lot of these technology sectors. Now, Bridget, when I talk about technology, I really like to categorize these property sectors into three different buckets. And again, they're all, broadly speaking, part of technology. I call it the tech trifecta. So think of this as a stool, and one leg to the stool is going to be cell towers. That's where a lot of our, tech, obviously, all of us look at cell phones every day, and all that data is communicated through the cell phone. And then it goes into a data center, which is the third leg to the stool in the tech trifecta. And those are mission critical, properties. Artificial intelligence, everybody loves it, and we certainly cover this at Wide Moat Research, but none of that would even happen if it weren't for data centers. And so that's certainly a property sector that we're extremely bullish about. And the third leg to that stool, again, is the logistics or warehouses. These are where a lot of technology within these logistics facilities. Amazon is obviously a big user of that type of space, or Best Buy. Some of those retailers all have logistics operations. And those are probably, in terms of real estate and the property sectors, those are the ones that are going to have the most growth potential. So I think investors should really, if they want growth opportunities in real estate, those three kind of, tech trifecta picks are really important. Again, we've seen a lot of new sectors that, frankly, 10 years ago, or certainly when I was in college a long time ago, I never thought about being able to invest in casinos, or I never thought about being able to invest in farmland is another interesting sector. Healthcare has a very broad lineup of subsectors. So you have skilled nursing, you have senior housing, you have medical office buildings, you have memory care centers, you have hospitals. So there's a lot of different ways you can invest in the healthcare sector. Manufactured housing is also a really interesting space. It also kind of rides on that silver tsunami demand that we see in the senior housing sector. So the aging population is certainly driving the growth of the manufactured housing sector. So there are a lot of ways that you can invest in REITs, and that's one of the great things. And we're seeing that evolution still continue with more and more REITs that are coming into the fold.
That's some great advice for our investors today. Thank you so much for sharing some of your knowledge in the industry and sharing which sectors our investors can look for in the new year. Thanks again for joining us, everyone. And as always, happy investing.